you would trade or how you could use moving average convergence and divergence, MACD, to make better decisions and to protect yourself. Now, MACD was developed by Gerald Orpel in the late 70s. And it's a rather grand sounding name. Like I said, I love the name, Moving Average Convergence Divergence Indicator. Now, it is one of the most popular indicators today in the Forex market, CFD market. Now, if we think back to the 1970s, there was virtually no computers. And there was no indicators, there was no online trade, there was no online trading. And basically the only trading that was actually happening was through the stock exchange. So the original MACD was developed and tested and used to spot changes in the strength, direction, and momentum and the duration of a stock's price. Well, as online trading grew, as Forex grew, as CFD trading grew, investors and technicians were looking for indicators with a proven history that would work in fast-paced online markets today, especially Forex. And then even as cryptocurrency started to grow, traders were looking for indicators that would adjust quickly for these markets. And with a couple years of testing, we found out that MACD is one of the best indicators to use because it reacts very quickly to the markets. Now, MACD falls into an area that's known as lagging indicators. Well, don't freak out over the word lagging. We have leading indicators and lagging indicators. Leading indicators, there's very few of. And it's not like in school when the teacher calls and tells you your kid's lagging behind the class or he's leading the class. A lagging indicator doesn't mean it's a bad indicator. Leading indicators predict what the market's going to do based on future things that haven't happened yet. Lagging indicators also help try to tell you what the markets will do, but it uses data that's already happened. In other words, it's using the open, the high, and the close from, in most cases, the most current period. But that period has already happened. So it's slightly lagging behind in the markets because it's using real solid market information. Okay. It tells you or helps you spot the strength and the direction and the momentum. Okay. And keep in mind, MACD doesn't predict what's going to happen forward. It helps you see what's going to happen maybe in the next time frame, but it doesn't tell you what's going to happen tomorrow, the next day. It's not a prediction tool. Now, the basic function of the MACD indicator is to discover new trends and help identify the end of the current trend. Now, these are important because a lot of times a trend has started to develop or it's starting to end, and you can't see it in your chart yet. But MACD will help you see this. Now, the MACD indicator is typically placed at the bottom of the trading chart in a separate window beneath the price chart. The moving average convergence divergence tool is a relatively easy to use tool. However, it is crucial to understand it fully before attempting to trade using its signals. And let's take that word away, signals, and let's say it's alerts. What MACD does, it hits you on the back of the head and says, hey, trader, take a look at this now. Now, we'll go over to some live charts in a minute, but the concept behind MACD is fairly straightforward. Essentially, it calculates the difference between an instrument's 26 and 12-day moving average. The two moving averages make up the MACD. And it moves on from there, but it's an indicator of an indicator. So it starts out with a simple moving average. So let me pop up a live chart, and I've got one ready for us for class. Okay, now we're looking at my teaching chart. This is the Euro US dollar live chart. The lines going across the chart are my support and resistance lines. They have nothing to do with tonight's particular class, but I always have support and resistance lines on my charts. Excuse me. Because every trader should have the support and resistance lines on their chart. And since they move forward because they're historical lines, I don't take them off my charts because it would take a lot of time to put them back on my charts. So MACD starts out by using a 12 period and a 26 period moving average. So I've already dropped my EMAs on my chart. So the gold line right here, let me put my highlighter on there, is the 12 period exponential moving average. Now we all know what an EMA is, a moving average. It goes back because MACD has been set up by Gerald Arpel to use a 12 period and a 26 period. This is from years of his testing, and this is the developer's formula. Okay. So a 12 period EMA means it would take the closing price for that asset for the last 12 closes. So since we're looking at a 30-minute chart, it would go back and look at the last 12 periods and the close of each one of those periods, add them together, and divide them by 12. Now, an EMA it gives more value to the most current period, and it's got a little bit more complex formula, but it gives a little bit more weight to the most current close. Then it takes a 26 period moving average, which is the same thing, but it goes back 26 periods, adds them together, divides it by 12, adds a little weight to the most last one, and gives you a 26 period EMA. And that, in this case, I put it on here in the purple line. Doesn't matter what color lines you're using. I just put them on here for visibility purposes. Now, we could trade from this all day, but if we did, this is just a moving average crossover strategy. It's a very simplistic strategy, a very simplistic indicator. It's been around forever. But MACD goes way farther, but you have to understand how MACD gets to where it's going, because that's how you will use it to make your smart trading decisions. So MACD starts out by taking the 12 period moving average and subtracting the 26 period moving average. And what would it give you? If the 26 period moving average was larger than the 12 period moving average, it would always come out at least to a negative number. If they were crossing each other, like right here, guess what? Both of those moving averages were the same. So the EMA and the 26 period, the 12 and the 20, would be exactly the same. And when you subtract the exact same numbers from each other, you get 0. And lastly, if the 12 period was larger than the 26 period, you would get a positive number. Okay. Now, this is shown, or this is known as the MACD line. And this is shown as the first part of MACD. And this is the blue line that I just dropped on the bottom of your charts. Okay, this is the difference. This blue line, and again, the color is not important, is called the MACD line. Now, when you add the MACD indicator to your charts, it's automatically going to do this for you. But this line is just the difference between those two lines above. So at this point, we no longer need these moving averages on our charts because we're using MACD below. Now, the green dashed line down below here is 0. So what does it tell you at this green dash line? Whenever this blue line touches this green line, we know the difference between the MACD, the two moving averages, is 0. We know they're crossing over to the up point. We know when it goes above 0, in other words, it moved up this way, that the 12 period is growing larger than the 26 period. When it goes down this way, we know that the 26 period is getting larger than the 12 period. Hence, we have a negative or a positive number above or below 0. And technically, the difference could be whatever number comes up. It's not locked into a range. It's not a bounded indicator. But for everything we've just done, is we have just displayed those same moving average calculations in just a different format. We haven't changed the calculations. We haven't done anything. So it'd still be a very simplistic moving average crossover strategy. So Giraudeau Appel took MACD one step farther. We're going to go several steps farther. But the next step he did was make what we call a trigger or a signal line. The signal line is a 9-period moving average of the blue line. So it's a moving average of the difference of the two above moving averages. So what are we doing? We're actually massaging a whole bunch of data. But we've also now moved away from a moving average crossover strategy because we're not looking that much at the 0. What we're looking at is the crossovers of the signal line and the MACD line. And this helps us see changes in the trend, changes in the momentum, and changes in the strength of the market. As we see this mountain or peak climb, that's telling us it's going through a strong buy period. As we see it come down, it's losing its momentum. When it goes down here, it's actually starting to reverse. So you can see how it kind of mirrors the price movement, but it's actually a little bit ahead. Now MACD takes us one more step. And here it adds on a fancy thing called a histogram. Now, we learned about histograms when we were in school. A histogram is just a fancy bar chart, basically. But for our trading purposes, it becomes very, very important. Because now we can see everything that's happened in this histogram. We can see the strength of the move. We can see when it's moving back down. We can see how fast it's moving. We can see the peaks and the valleys. We can see all the shifts in the market. Now, you can trade as you want. You can use it as you want. I don't use the MACD and the MACD signal line. I use strictly the histogram because the histogram is just a combination of all of those numbers put on an easy to see graphic chart. So I know every time my histogram is flipping from red to green or green to red, I know the market momentum is shifting. I know I'm getting a reversal in the trend or in the markets. I can see how deep it is. So it can tell me whether I'm getting overbought or oversold. I can see when it's losing its momentum and peaking down. Like here, even though the markets are slightly moving up, we see that it's got very little strength in that upward movement. Then when it peaks down, we have a lot of strength in that downward movement. So we can see a lot of pieces of information using our MACD. And we can actually see how these slightly beat the actual shifts in the market, so that we're seeing these right before the market makes the move. So we can then decide if we're in the markets what we want to do, if we're getting ready to enter the markets what we can do. And we can use this to make intelligent decisions. So let's go back to my PowerPoint for a minute here. Okay, so the MACD histogram is an elegant visual representation of the difference between the MACD and its 9-day EMA. The histogram is positive when the MACD is above its 9-day EMA and negative when the MACD is below. If prices are rising, the histogram grows larger as the speed of the price movement accelerates and contracts as the price movement decelerates. The same principle works in reverse as prices are falling. Now, the moving average convergence divergence indicator is both a momentum oscillator and a price-based oscillator, and is one of the most reliable studies that we have. While it is a lagging indicator, it works well in all time frames and with all stocks, futures, crypto contracts, and whatever. It is a highly interpretive probability signal that is based on the difference between three moving averages and its histogram. While it is slower than momentum indicators such as stochastics and RSI and CCI, if you're willing to sacrifice a little bit of speed, is considered a good way to keep you on the right side of the markets. Now, if you notice when we were looking at the charts and we were looking at the MACD indicator and comparing it to the candlestick charts above, I never mentioned a price. Okay, one of the most important things you have to keep in mind is MACD gives you alerts. It tells you about shifts in the market, but it doesn't tell you where to enter the market, where to exit the market, and it doesn't tell you how long that shift of momentum is going to take, or will take, or how long it will sustain. So sometimes a shift downwards can very quickly turn into a shift upwards. Okay. So MACD doesn't tell you to enter the market here and exit the market there. It also doesn't give you target points or risk management points. It gives you information. Now, MACD gives us three different stories that we can use. These three stories, or three purposes, are convergence and divergence, overbought and oversold conditions, and crossovers. Now, the basic MACD trading rule is to sell when the MACD line falls below its signal line, simply to buy when the MACD line rises above its signal line. Okay. This is a big fallacy. Okay. These are not signals to buy or sell. This is how newbie traders would like to interpret this. What they are alerts telling you there's been a shift in the market. If you were considering buying or selling, you should be looking harder at this point because there's been a shift. Otherwise, you're basically making the same interpretation as a moving average crossover strategy. Now, the MACD is also useful as an overbought and oversold indicator. When the shorter moving average pulls away dramatically from the longer moving average, it's likely the symbol price is overextending and will soon return to more realistic levels. Okay. Now, you can see that by looking for lots of lines on your charts, trying to see convergence and divergence. I simply look at the histogram and I look at the depth of the histogram. When that histogram gets extremely high, I know the market's getting overbought. When I see it dip very, very low, I know the markets are getting oversold. Now, divergence is another point. Okay, I don't ever look for convergence and divergence. Okay, I think it's very hard to see in the markets. Divergence is when the overall market price is moving one direction and your indicator is moving in a different direction. So in other words, like at this point, we see that the market is falling, but we actually see that the indicator is climbing. I don't deal with bullish and bearish divergence. I don't even see the significance of it all, but a lot of traders do, because you still have to wait for something important to happen. But people swear on divergence. I just don't. So I got to be honest with you. I'm not an expert at explaining it all to you because I just don't use it for anything. But keep in mind that the MACD histogram is an indicator of an indicator. In fact, MACD is also an indicator of an indicator. That means that the MACD histogram is 4 steps removed from the price of the underlying security, which is important because we've taken that data and recalculated, used it in different formulas to come up with something, because all we have that we can use is the open, the high, the low, and the close. So the rest of it becomes statistical and mathematical formulas that are applied to the indicators. So the first derivative is the 12-day EMA and the 26, the 2 lines we saw on the top of the chart we started off. The second derivative becomes the 12-day moving EMA, or the 12-period EMA, less the 26. That was the MACD line that formed that first blue line on the chart. The third derivative is the MACD signal line, which is a 9-day EMA of that blue line. That was the second line we put on the charts. And the fourth derivative is the MACD histogram, which is the MACD less the MACD signal line. So that histogram has combined that first derivative, the second derivative, the third derivative, and given it to you in an easy to see visual format. The base for the indicator is the securities price. It takes 4 steps to get from the actual price to the MACD histogram. Well, not necessarily a bad thing. Charters should keep in mind that when analyzing the MACD histogram, it is an indicator of an indicator. Therefore, it is designed to anticipate alerts in MACD, which in turn is designed to identify changes in price momentum of the underlying security. Now, as with MACD, the MACD histogram is also designed to identify convergence, divergence, and crossovers. Now, please keep in mind these signals, and we're calling them transaction signals or alerts, because they aren't really buy and sell signals. Okay, but they occur whenever we cross the 2 lines or we cross the 0 line. Whenever we cross that 0 line, we know that the 2 lines or the 2 moving averages have now equaled each other and crossed over. But then in the histogram, we can see the strength of which is moving towards the 0 line and whether it breaks through or bounces off the 0 line, which is telling us a lot about that price movement. So it's important to keep in mind, or keep an eye on that 0 line, the center line, and see where prices not just breaking through it, but where it's moving as it gets closer. What's its momentum as it's coming towards that 0 line? So at its most basic level, the MACD indicator is a very useful tool that can help traders ensure that they are trading on the right side of the markets, and to ensure they're working with the short-term direction in their favor. The biggest disadvantage of using this indicator to generate signals is that a trader can whipsaw it in and out of position several times before being able to capture a strong change, because the MACD moves quickly. It moves in relationship to the moving averages, which are calculated on the most recent prices, because the MACD doesn't tell you, when it gives you a buy or sell alert, how far that's going to go. It doesn't give you a target point. It doesn't tell you how long it's going to carry through, and it doesn't tell you the entry point. So traders should be aware that the whipsaw effect can be severe in both trending and range-bound markets because relatively small movements can cause the indicator to change direction quickly. A large number of false signals can result in a trader taking many losses. So the MACD indicator is one of the most popular tools in technical analysis because it gives traders the ability to quickly and easily identify the short-term trend direction, see easily the momentum in the markets, the strength of the move. The clear transaction signals help minimize the subjectivity involved in trading, and the crossover of the signal line make it easy for traders to ensure they are trading in the direction of the momentum. Very few indicators in technical analysis have proved to be more reliable than the MACD, and this relatively simple indicator can quickly be incorporated into any trading strategy. As you see, it wasn't very complicated. All you simply do is click on the MACD. Here, let me take you to the chart and we'll do it step by step. Let's get rid of MACD right here. And to add MACD, all we do is go to our indicators, find our MACD, and it automatically does all of that for you. Then you decide what, you can personally change the settings and change the color format you want. You can change the lines, you can change whatever, but that's personalized, customized stuff. But it just drops it down on your below chart, so you don't have to do anything. It's all ready for you to start trading with. So we have a simple indicator that's a very advanced indicator, but very simple to add to your charts and extremely easy to apply and understand. Because in most cases, you're using your eyes. When using the histogram, you're simply looking at a pretty little representation of price movement. And it tells you lots of information. We can simply look here. We can understand the markets tumbled, came to zero, but they didn't have any momentum to carry it at all this point any lower. But then look at that. It started to gain momentum. The fall. Maybe you wanted to enter market, but it never gained any, and then it moved back up to zero. And now we're sitting right here and we can see it gaining that momentum. It's moved above the zero line and we can see that momentum gaining. So maybe we'd want to enter the markets. It gives us lots of information and easy to understand format. Okay. And it helps you actually exit the markets. If you were in a short position through here, as this started to climb up, you'd want to get out of your position. It doesn't tell you what price you want to get out of it, but it's saying, hey, take a look at your position. Maybe you want to get out. So it gives you a lot of information in an uncomplicated form that is relatively easy for you to add into your trading system without spending years learning how to do it and interpreting it and using all these technical stuff. MACD is an easy to use, friendly indicator that serves many purposes and adjusts to any time frame that you want to trade in. If you're trading in a 5-minute or 10-minute time frame, MACD will work great for you. And there's very few indicators that work very well in short-term time frames. So on that note, I'll say good night to everybody. Thank you very much for joining us. I hope I gave you some food for thought, because again, like I said, all I can do is give you some information, some things to think about, and then you need to start applying MACD and start learning how to visually use it and add it into your decision making. So have a great night. Thank you for being part of Elvexo, and we'll talk to you again real soon. Bye now.